Your low-cost ETF might be charging you 3 to 5 times more than you think. If you invest from the UK or Europe, this matters even more. There's no scare tactics here, just the math. In this video, I'm going to name the 5 hidden drags most people miss, show a real broker example with a 10-year side-by-side, and give you a 60-second checklist to keep more of your returns. And by the end of this video, you'll know exactly what to look for before you buy your next ETF, and the one fee almost no platform puts on their pricing page. Let's fix this so compounding works for you and not against you. Okay, so let me explain the problem. Here's 2 neighbours. They have the same investing goal on the exact same day. Alex and Priya each put £10,000 into a UCITS S&P 500 tracker. On paper, both funds look ultra low cost at 0.07% and 0.03%. They reinvest the dividends and never touch a thing for 25 years. You'd expect near identical balances, but Alex finishes £30,000 short. The same underlying index, the same timeline, and no market timing mistakes. So what happened? It wasn't the market, it was friction. These can be broken down into trading costs inside the fund, spreads where you buy and sell, tracking shortfalls, and other tiny drags that don't show up next to the headline fee. They don't appear as a tidy line on your broker statement, they show up as missing money. This isn't rare. It's what happens when we shop for ETFs by the bold print but ignore the footnotes. The 0.03% or the 0.07% you see on the fact sheet, that's the base fare. It keeps the lights on. However, what it doesn't guarantee you avoid are portfolio transaction costs, which is rebalancing the index, which means the fund pays brokers to do this. Bid and ask spreads, which is the gap you cross every time you trade. Slippage, which is what you're expecting to pay versus what you actually pay. Cash drags and replication method quirks. This is how well the fund actually tracks the index throughout the year. Individually, these look small, but when compounded, they can be real. Your cheap ETF can behave like a 0.30% or 0.40% fund in the wild if you pick carelessly and trade badly. So what you need to look for in the UK or European investments, the fact sheet's ongoing charges figure, or the OCF, and the portfolio transaction costs, which is shown in the annual report, sometimes called the TER or transaction costs. General rule of thumb is the OCF plus the transaction costs equals your effective ongoing drag. It's worth knowing that plain vanilla, broad, popular UCITS trackers often have transaction costs around 0.3 to 0.7%, so quite cheap. But higher churn factor or thematic ETFs can hold much higher fees, somewhere around 0.4 to 0.7%, which is quite common. So it's a bit more expensive. Compare the sum, not the marketing line. If a fund flaunts 0.07% OCF but hides a 0.14% transaction cost, it's more expensive than a rival 0.15% OCF with negligible trading costs. So take action. Open up the latest annual report, head over to the financial highlights or expenses section, then add them up yourself. If a provider is vague, it can be safer to pick a clearer one. Tracking difference isn't a fee you pay. It's part of the return you simply don't get. Tracking difference equals the index return minus the fund return, so the average shortfall. Tracking error is volatility of that shortfall, so how wobbly the gap is between the index and the ETF. If an index does 10% in a year and your ETF does 9.65%, the 0.35% missing is the tracking difference, and it compounds annually, so check it yourself. Go to the performance history for the ETF and its index. You'll generally find this on the provider's site. The tighter and more consistently the ETF tracks the NAV, the better. Core trackers, I would aim for less than 0.2% average annual shortfall, but the closer to 0, the better. If you see over 0.5% consistently, without any good reason like illiquid markets, then you might want to consider alternatives for your core holdings. Every trade crosses the bid-ask spread. On deep liquidity UCITS broad trackers, it can be 0.01% to 0.03%. On more niche illiquid ETFs, 0.20 to 0.40% is pretty common. You can shrink it with 3 habits by using limit orders, especially when buying outside mega caps. Trading at peak liquidity, so typically between 2:30 and 4:30 p.m. London time on the weekdays. This is because the US market is open and Europe is still active, so you've got the most number of traders. Prefer UCITS ETFs with healthy daily turnover and multiple market makers. If you're pound cost averaging monthly, a persistent 0.30% spread is a silent front-end load you pay again and again and again. So keep this in mind when deciding your investing frequency. Let's prove this with some real data. We'll take a look at 2 case studies. So the funds I've chosen here is VUSA, which is a Vanguard S&P 500 UCITS ETF. It's a broad US market, distributing dividends and unhedged. EQGB, which is the Invesco EQQQ Nasdaq 100 UCITS ETF, but it is hedged and it's accumulating. So things to note about these 2 ETFs. They are different indices and hedging. We're comparing each of the ETFs to its own benchmark, not each other, and not stock selection. You want to pull up the menu price versus the real price. So open up each fact sheet. Have a look at the OCF figures. Now open up the annual report. Note any transaction costs, so portfolio trading and transaction fees. Remember to compare both the OCF and the transaction costs together, not just the OCF on its own. One thing worth noting here, VUSA is distributing. So if you reinvest the dividends manually, that is an extra spread and friction cost on each investment. So again, frequency is worth bearing in mind. EQGB is GBP hedged. So currency hedging can add a small persistent tracking shortfall versus the raw index. Load up the 10-year total return charts. So here we've got each of the total returns from these 2 ETFs. And you can see a clear difference between what the ETF has returned and what the NAV has returned. So why have these gaps happened? So potential pain points for the friction. Distributions. Your manual reinvestment crosses spreads each time. Tracking differences equals the fee plus tiny cash drags. So the pound hedging introduces a small ongoing hedging cost on a rolling basis. It's often wider spreads because it's a less popular ETF tracker. The tracking differences include both the fees and hedging effects. Tiny repeat costs means compounding shortfall. Okay, so let's make this concrete. When comparing ETFs, even when it's ETFs that track different indices, measure each against its own benchmark and compare the friction delta. Add the OCF and the transaction costs. Look in the annual report for these. Check the multi-year tracking differences versus the stated benchmark. If using limit orders, check the medium spreads at the highest trading hours. Be mindful that distributing classes add reinvestment friction. Accumulating can avoid that, but choose your preference wisely. Hedged ETFs accept a small, persistent hedging costs in exchange for potential currency risk reduction. Make sure it's worth it for you, as it may or may not be. So next time someone says, just buy the cheapest ETF, give them a smile and run this checklist. By doing this due diligence, you can set yourself apart from the rest and be more at ease with your investments. Your new edge isn't hype. It's seeing the invisible costs, doing 30 seconds of extra homework, and refusing to donate returns to intermediaries. Leave me a comment letting me know what hidden costs you've caught before buying or selling. Like to help other UK and European investors keep more of their gains, and subscribe to the channel, and I'll see you in the next video, where we turn more fine print into actionable pounds and pence wins.